Imagine it is September 12th, 2008. You're a 43-year-old maintenance supervisor living in Lehigh Valley, Pennsylvania. You have worked at the same factory for 19 years. You earn $52,000 a year. You have a modest house with a fixed-rate mortgage, a wife who works part-time at a dental office, and 2 kids in public school. Your retirement savings sit in a 401k that your company matches dollar for dollar, and most of that money is invested in your employer's own stock because they encouraged it and you trusted them. You've done everything right. You show up early, leave late, pay your taxes, and never carry a credit card balance. Your life is not glamorous, but it is stable. You sleep well, you feel safe. If you have ever wondered why companies that look perfectly healthy on the outside can collapse without warning, dragging millions of ordinary workers and investors down with them, stay with me. What you're about to hear is not a theory. It is a pattern. It has happened before, and it always ends the same way. And if you find value in this kind of historical clarity, subscribing takes 2 seconds and keeps you ahead of what most people never see coming. Now let me tell you what happened to that maintenance supervisor. On September 15th, 2008, Lehman Brothers filed for the largest bankruptcy in American history. But that is not why his life changed. His life changed because the company he worked for, a mid-sized auto parts manufacturer, had spent the previous 5 years borrowing money at low interest rates to buy back its own stock, fund executive bonuses, and acquire smaller competitors at inflated prices. On paper, the company looked like it was growing. Revenue was up. The stock price had doubled. But underneath, the company was carrying 4 times more debt than it had in 2003. When the credit markets froze in the fall of 2008, the company could not roll over its short-term loans. Within 6 months, the factory closed. The stock went to zero. His 401k lost 87% of its value. He was 43 years old, unemployed, with retirement savings that would not cover a single year of expenses. This video is about corporate debt, not the kind of debt your neighbor puts on a credit card. Not government debt, which gets all the headlines. Corporate debt, the trillions of dollars that businesses around the world borrow to operate, expand, and sometimes to do things that have nothing to do with building anything real. This is the debt that hides behind rising stock prices and confident earnings calls. This is the bomb under the global economy, and most people do not even know it exists. Before we go further, there is something important to understand. Debt itself is not evil. Debt is a tool. When a company borrows money to build a new factory that will produce goods and create jobs, that is productive debt. It is like taking a loan to buy a plow so you can farm more land. You borrow today, you produce tomorrow, and the production pays back the loan with plenty left over. But there is another kind of borrowing. It is when a company borrows money not to build anything, not to hire anyone, not to create a single new product, but simply to make the stock price go up. They use the borrowed money to buy back their own shares. Fewer shares on the market means each remaining share is worth more. The stock price rises. Executives whose pay is tied to the stock price get richer. Investors feel good. The company looks like it is thriving. But nothing was actually built. No new factory, no new product line, no new job. The borrowed money did not create a single dollar of new productive capacity. Think of it like a homeowner borrowing money against their house, not to fix the roof or add a room, but to throw a party. The house looks the same from the outside, but now there's a bigger mortgage and the roof still leaks. That is the mechanism. That is what has been happening across the global economy at a scale that is almost impossible to comprehend. And the thing about this kind of debt is that it works beautifully right up until the moment it does not. This brings us directly to the first case study, and it begins in a place most people would not expect. In the early 1990s, Japan was coming off the most spectacular asset bubble in modern history. Property prices in Tokyo had reached a point where the grounds of the Imperial Palace were worth more than all the real estate in California. When the bubble burst in 1991, the Japanese government responded by slashing interest rates to near zero. Money became almost free to borrow. Japanese corporations, especially the large conglomerates known as keiretsu, took advantage. They borrowed aggressively. But instead of using that cheap money to innovate or restructure, many of them used it to keep zombie operations alive. A zombie company is a business that earns just enough revenue to pay the interest on its debt, but never enough to pay down the principal, which is the actual amount borrowed. It is a company that is technically alive, but economically dead. It keeps going only because the debt is so cheap that it costs almost nothing to maintain. By the late 1990s, estimates from the Bank of Japan and academic researchers suggested that as many as 30% of publicly listed Japanese companies fit the definition of zombie firms. They occupied space. They employed people. But they did not grow. They did not innovate. They blocked newer, healthier companies from entering the market. Japan's economy, once the envy of the world, entered what economists now call the lost decade. Except it was not one decade. It stretched into 2 and arguably 3. Between 1991 and 2011, the Japan stock market index, the Nikkei 225, never recovered its 1989 peak. Average wages stagnated. Young people entering the workforce in the late 1990s earned less in real terms than their parents. The rot was not on the surface. The surface looked calm, orderly, even prosperous. The rot was in the foundation, in the debt that kept dead companies standing while the living ones could not find room to grow. For ordinary Japanese workers, this meant something deeply personal. It meant that the promise of lifetime employment, the social contract that had defined their parents' generation, slowly dissolved. It meant working harder for less. It meant watching your savings earn almost nothing because interest rates were pinned to the floor to keep the zombie companies from collapsing. The debt was not theirs, but the cost was. This leads to the second part of this story. Here is something I want you to think about before we go further. If a company borrows billions of dollars and uses it to buy back stock, who actually benefits? The executives? The shareholders? The workers? Drop your answer in the comments. Seriously. Because what I am about to show you next is the part of this story that most people never hear. And it changes everything. Let us move to the United States in the years between 2010 and 2019. After the 2008 financial crisis, the Federal Reserve cut interest rates to near zero and launched massive bond buying programs called quantitative easing. The official goal was to stimulate the economy, to make borrowing cheap so that businesses would invest, hire, and rebuild. And in some ways it worked. The economy recovered. Unemployment fell. But something else happened that very few ordinary people understood at the time. American corporations went on the largest borrowing binge in history. Between 2010 and 2019, U.S. non-financial corporate debt grew from roughly $6 trillion to nearly $10 trillion. That is a 67% increase in less than a decade. Where did the money go? According to research, a staggering proportion went to share buybacks and dividends. Between 2010 and 2019, S&P 500 companies spent approximately $5.3 trillion on stock buybacks alone. In many years, companies were spending more on buybacks than they were on capital expenditures, which is the money used to build factories, buy equipment, and develop new technology. Think about what that means. Companies were borrowing money to shrink, not to grow. They were borrowing to reduce the number of shares outstanding, which pushed stock prices higher and made executives wealthy. Meanwhile, the actual businesses were not getting stronger. They were getting more fragile. A company with a healthy balance sheet can survive a bad quarter. A company loaded with debt cannot. It is the difference between a house built on rock and a house built on sand. Both look the same in good weather. The real test comes during the storm. In 2019, the Federal Reserve flagged something alarming. The share of corporate debt, rated BBB, the lowest tier of investment grade, had reached its highest level ever. BBB is one notch above junk. One downgrade and billions in bonds would be reclassified as high yield or high risk. Many large institutional investors are legally required to hold only investment-grade bonds. If a wave of downgrades hit, these institutions would be forced to sell, flooding the market with bonds nobody wanted to buy. This was not a distant hypothetical. The mechanism was loaded. The fuse was cut. All it needed was a match. The match arrived in March 2020. When the COVID-19 pandemic shut down the global economy overnight, corporate revenues collapsed. Companies that had borrowed heavily to buy back stock suddenly had no cash reserves to fall back on. The corporate bond market seized up. BBB spreads roughly tripled in a matter of weeks. The Federal Reserve stepped in with an emergency program, buying corporate bonds and junk bonds directly. The central bank effectively became the buyer of last resort for corporate America. Markets calmed. But the message sent to every boardroom was clear. Take risks, borrow heavily. If things go wrong, the central bank will save you. The floor beneath corporate debt was no longer the market. It was the government. This moral hazard planted seeds for larger problems. Most people will never know what you now know. Most people will keep trusting systems they do not understand. If you're still here, you are not most people. Hit subscribe. Because the next section is the part they never put in textbooks. C. 2026, Script Scene Splitter, AI GitHub. Now observe what all of these cases have in common. In Japan, ultra-low interest rates allowed zombie companies to survive on borrowed money for decades, strangling the economy's ability to grow. In the United States, the same cheap money fueled a massive debt-funded buyback machine that enriched executives while hollowing out corporate balance sheets. And then in 2020, when the system cracked, the response was not to let the market correct itself. The response was to inject even more liquidity, lower rates even further, and effectively guarantee that the borrowing would continue. Now look at a third case that brings these threads together. In 2022 and 2023, the United Kingdom experienced something that most people outside financial markets barely noticed. It nearly brought down the British pension system. In September 2022, the new British government under Prime Minister Liz Truss announced a set of unfunded tax cuts. The bond market reacted violently. British government bond yields, known as gilt yields, spiked at a speed not seen in decades. The 30-year gilt yield rose by more than a full percentage point in just a few days. This might sound like an abstract number, but the consequences were immediate and terrifying. British pension funds, which managed the retirement savings of millions of ordinary workers, had been using complex financial instruments. These were called liability-driven investment strategies. In plain terms, they had borrowed money against their bond holdings to boost returns. When bond prices suddenly dropped, the value of their collateral, which is the asset you pledge when you borrow, collapsed. The pension funds faced margin calls, which means the lenders demanded they put up more cash immediately or sell assets. The Bank of England had to intervene with an emergency bond buying program to prevent a cascade of forced selling. This program protected pension funds managing over £1 trillion in assets. This was not a crisis caused by reckless individuals or fraudulent companies. This was a crisis caused by the structural dependence on cheap debt. Pension funds that were supposed to be the safest, most boring corner of finance had become leveraged. This means they were borrowing to invest because decades of low interest rates made it impossible to earn adequate returns any other way. The ordinary British retiree had no idea this was happening. They were not consulted. They were not warned. They simply woke up one morning to headlines about a pension crisis and wondered if their retirement was still safe. The same mechanism, different countries, different decades, same result. And this is where history gets uncomfortable, because the pattern does not hurt everyone equally. The first people to feel the pain are always the ones furthest from the levers of power. In every historical case, when corporate debt spirals lead to crises, the sequence of suffering follows a predictable order. First, the workers get laid off. In the 2008 financial crisis, American companies shed 8.7 million jobs. The unemployment rate peaked at 10% in October 2009. But corporate profits recovered within 2 years. The stock market recovered within 4 years. Executive compensation recovered even faster. By 2013, CEO pay at the top 350 American firms was 296 times the average worker's salary. This is according to the Economic Policy Institute. The people who lost their homes and their savings and their careers in 2008 were not the people who had created the risk. They were the people who had been told every day that the system was solid. They were told their company was strong and their pension was safe. Second, small businesses get crushed. When credit markets tighten during a debt crisis, the first borrowers to be cut off are not the giant corporations. They are not the ones with teams of lawyers and direct lines to central bankers. The first to be cut off are the small and medium enterprises and family-run shops. These manufacturers employ nearly half the private workforce in most developed countries. They cannot issue bonds. They do not have access to emergency lending facilities. They simply close. Third, pensioners and retirees get squeezed. When interest rates are slashed to save over-leveraged corporations, those who depend on fixed income investments see their returns evaporate. A retiree in 2006 could earn 5% on a certificate of deposit at their local bank. By 2012, that same certificate of deposit earned less than 1%. Their cost of living kept rising. Their income from savings collapsed. Nobody called it a wealth transfer, but that is exactly what it was. Money flowed from prudent savers to reckless borrowers, facilitated by central bank policy. This policy was designed to keep the debt machine running. Meanwhile, those who owned assets, particularly real estate and stocks, watched their wealth soar. The top 1% of American households saw their net worth increase by more than $10 trillion between 2009 and 2019. This is according to Federal Reserve data. The bottom 50% saw almost no gain. The gap was not an accident. It was the direct mathematical consequence of a system that subsidized debt. At this point, the pattern becomes impossible to ignore. The question is not whether this pattern will repeat. History has already answered that. The only question is whether you will see it before it sees you. If this channel helps you think differently about the world you live in, subscribe. It costs nothing, and it might change everything. Now, what did the survivors do? This is historical observation, not financial advice. When historians look back at the people who came through corporate debt crises intact, certain characteristics appear. The first characteristic was diversification, which simply means not putting all your eggs in one basket. The maintenance supervisor in Pennsylvania lost everything because his retirement savings were concentrated in one company's stock. This was not unusual. In the Enron collapse of 2001, employees had an estimated 62% of assets in Enron stock. When the company went bankrupt after a massive accounting fraud, 20,000 employees lost their jobs and savings simultaneously. In contrast, those who spread their investments across different industries and asset classes consistently fared better. The second characteristic was low personal debt. In every major financial crisis, the people who suffered the most were those who were themselves leveraged. They had mortgages they could barely afford and car payments stretched over 7 years. When the economy contracted and jobs disappeared, they had no cushion. Those who lived below their means and maintained 6 to 12 months of expenses had time. Time to wait out the storm, time to find new work, and time to avoid selling assets at the worst moment. The third characteristic was financial literacy, which means understanding how money and markets actually work. People who understood that a rising stock price does not necessarily mean a healthy company were less likely to be caught off guard. They could read a balance sheet and knew the difference between revenue and profit. They understood that when a company announces a massive share buyback program funded by debt, that is not necessarily good news. It might mean the company has run out of productive things to invest in. It might mean executives are engineering a short-term stock price boost to cash in their options. Historical literacy was the filter. It did not guarantee survival, but it made the warning signs visible to those who knew where to look. The fourth shared characteristic was skepticism of consensus. In the lead-up to every major financial crisis, the prevailing narrative was overwhelmingly optimistic. Before 2008, the consensus was that housing prices never fall nationally in the United States. Before Japan's bubble burst, the consensus was that Japanese management methods were superior. Before the UK pension crisis, the consensus was that liability-driven investment was a perfectly safe strategy. In every case, the people who questioned the dominant story were dismissed as pessimists or cranks, until they were proven right. Now, let me bring you back to the maintenance supervisor in Lehigh Valley, Pennsylvania. After losing his job and most of his savings in 2008, he spent 14 months unemployed. He eventually found work at $38,000 a year, $14,000 less than he had been earning. He retired at 67, with far less than he had planned because the company he trusted had turned into a debt machine. The global corporate debt load today stands at levels that would have been considered extraordinary 20 years ago. According to the Institute of International Finance, global non-financial corporate debt exceeded $92 trillion by the end of 2023. In the United States alone, corporate debt to GDP ratio hovers near historic highs. The number of zombie companies has grown in Europe, the United States, and Asia alike. The Bank for International Settlements has warned that prolonged low interest rates have encouraged excessive risk-taking. The mechanism is understood. The history is written. Corporate debt is a hidden accelerant. It is a fire that burns from the inside out, invisible until the structure gives way. This is educational analysis. Please consult a qualified professional before making any financial decision. If one person in your life needs to hear this, share it with them. Subscribe for more. C. 2026. Script Scene Splitter AI